Time value of money is a very important aspect when it comes to investments and businesses. And if you are an investor, then this video is for you. We say that money available right now can be used to grab opportunities or undertake projects that are not going to be available in future. And of course, money available right now can be used to cover for risks and uncertainties that are likely to occur in future. Just as the word suggests, time value of money, it is just how money changes with time. Like, for example, if you look at maybe 15 years ago, when the late Moi Kibaki was the president of Kenya, the economy was doing so well. And 20 years down the line, and if you look at then, the value of money was higher. And if you look at 20 years down the line, you can see how money has gone down in value. You could purchase a lot of items with 1,000 Kenya shillings, but right now you cannot purchase a lot of items with 1,000 Kenya shillings. That is just a simple illustration of showing you how money goes down in value with time. But going deeper into that, by the way, if before I continue, if you don't know me and you are seeing me for the first time, my name is John. I'm a professional accountant, a financial advisor, a consultant. And if you're there, you have not followed me, make sure you give me a follow. You like the video, plus even on my bio, I have a YouTube channel. You can follow me there. You can subscribe so that you can be getting these similar videos. Thank you so much. We continue with our business today. Now, time value of money is broadly categorized into two main categories. Number one is, if you are an investor, you must have heard of these of terms. And number one is compounding, and number two, discounting. Now, without wasting time, I want to explain the narrative behind these two broad terms that are used in investments such as money market funds, such as treasury bills and bonds, and those investments that there are so many. They normally use the aspects of compounding and discounting, and it's very, very important. You see, here we are talking about how money changes in value. Either it loses value or it gains value, but I don't know why in most cases money loses value with time. And you are seeing how investments actually uses the aspects of compounding and discounting when it comes to money. Now, for example, let me start with compounding, and I'm just going to use a very simple illustration to show the difference between compounding and discounting, and how you can use this even when you want to do your investments, for example, in money market funds, in treasury bills and bonds, and so on and so that you are not investing blindly. When you decide to undertake a certain investment, when it comes to financial investments and government securities, you know exactly what you are doing. For example, if you decide to invest 500,000, you can actually be able to know the amount that you expect in 10 years time period, and so on and so on. So now, when it comes to compounding, let me do a very simple illustration here. We have compounding here. We have compounding and we have discounting. Now, when it comes to compounding, it's simply knowing the amount of money, that is simply knowing the future value of the amount of money that you are likely to get if you invest a certain amount of money right now. So, for example, if you have a present value right now, it's simply knowing the future value in maybe after that investment period. Let's call it investment period. Now, for example, if you decide to invest, 10 million right now, if you decide to invest 10 million right now, compounding is just knowing, and of course you are going to be given the rate at which you are compounding here. Of course, when it comes to compounding, you will be given the number of years in which you are compounding. For example, 10 years, you are going to be given the rate at which you are compounding, for example, 12% net taxes, and so on and so on. So if you have 10 million right now, you want to determine the amount of money that you are going to have in 10 years time. So this is 10 years. This is 10 years investment period. So if you have 10 million right now, you're actually calculating the amount of money that you are going to get in 10 years time when you decide to invest 10 million in different investment accounts such as bonds and money market funds. And this aspect of compounding is mostly used by money market fund accounts and of course in treasury bonds, government securities. But when it comes to discounting is actually is the vice versa of the compounding, because here it's like you want to determine, you want to find out the money that you need to invest right now so that you can have you can have 10 million, the money you want you would invest right now so that you can have 10 million in 10 years to come. This is 10 years uh 10 years investment period. Of course, it is very simple like that. When you hear you, unajua mnaambiangwa, people are told that money market fund compounds your money daily. Of course, compounding, it's done daily depending on how your money is being invested daily. So when you hear the term compounding, it's just money investment in money invested today and money that you're going to get, you are likely to get in 10 years time. And when it comes to here, when it comes to compounding, of course there is that starting capital, for example 100k that you decide to start with, and the amount that you are going to contribute monthly. And that money that you're going to contribute monthly, those are called annuities. And annuities can be categorized in two broad categories. We have ordinary annuities and annuity dues. That money that you contribute at the end of the month, that is an ordinary annuity. But if you contribute that amount at the beginning of the month, that is an annuity due. That is the difference. So you start with an initial capital of 10 million, and of course, maybe probably you're going to be contributing 50,000 per month, and those are called annuities. But this is what we call an initial investment. Whatever you're going to get here, I'm going to do an illustration in our next video of how you can invest different amounts in treasury bills and investment accounts to see the amounts that you are likely to get, so that whenever you want to do an investment, you have a clear picture of what you are doing. And then discounting, of course, is the same way. If you want to attain a threshold of 10 million in future, what amount of money do you invest right now? And this one is mostly used by corporations and companies whenever they want to do an investment. And for example, they want to attain a certain, for example, they want 100 million in future. They want to know the amount of money they can invest today. All right, guys, that is all about the time value of money. And in our next video, we are going to do different examples to see how we can apply this, the compounding and discounting, and see how we can be able to help each other. Thank you very much. That's our video for today. Continue following, subscribing in my YouTube channel, and we help each other in this financial journey. Thank you so much and have a nice time. We meet in our next video.